Welcome back to our channel. Here we try to give some valuable tips and tricks about financial freedom. In this video, we will help you guys by suggesting some amazing and proven strategies to invest your $1,000 and turn into millions. If you have got $1,000 in your saving account, but what are you going to do with it? It might seem like a lot of money to spend all at once. But is $1,000 enough to make a difference? The answer is yes. A $1,000 saving account is a great starting point for investing, and it can make a big difference in your financial future. We have listed some of the best ways to invest a $1,000 account below, and we have also explained how you can decide which option works best for you. Some investments offer higher returns but come with a higher risk. If you have a financial safety net that allows you to take on this risk, then these investments may be worth considering. If you don't, you can use the $1,000 account you have saved to correct. The first thing you should try is to create an emergency fund. It is necessary to create an emergency fund because it is vital for your financial freedom. When you experience an unexpected expense, such as a loss of a job, medical expenses, or unexpected home or a car repair, having an emergency fund will help you avoid budget stress or debt. Most experts suggest having 3 to 6 months of living expenses should be in an emergency fund. However, if you don't have enough money in your emergency fund, you can still save up to $1,000. Park your emergency fund in a high-yield saving account. A high-yield saving account is a great way to park your emergency fund. This is because high-yield accounts are typically FDIC insured, meaning they are essentially risk-free. Some high-yield saving accounts are now offering about a 5% annual percentage yield, which has not been seen since the late 1990s. Number 2 strategy is credit card debt should be your top priority, especially when you are dealing with high interest rates. For example, let's assume you have a credit card balance of $1,000 and a 20% annual percentage rate. You have to pay a minimum of $25 a month for the balance to be paid off in 67 months. You have lose $661 in interest, or you could pay off the entire balance in one go and avoid interest charges altogether. If you owe significantly more than $1,000, you may want to consider a credit card or interest consolidation loan to help reduce your credit card debt. For example, the Wells Fargo Reflect card has a 21-month intro APR on purchases and eligible balance transfers. The intro rate is 5% with a minimum $5 BT fee. Third strategy is you should put your money into retirement plan. Your retirement funds are another important part of your financial plan. If your employer has a 401,000, you may not be taking advantage of it. It's also a good idea to set aside 15% of your yearly income for retirement, including any contribution from your employer. If that doesn't seem like much, a $1,000 contribution can make a big difference. You can also invest in an individual retirement account if your employer does not offer a retirement plan. For 2023, the individual retirement account contribution limit is set at $6,500. If you are over 50, the limit is $7,500. Another important strategy is open a certificate of deposit CD. If you have an emergency fund in a good shape or on track to contribute to your retirement plan and don't have any interest debt, you might not want to take on risk with your money. That's where a CD comes in. A CD is a type of deposit account that allows you to earn a fixed interest rate on the money you deposit for a set period of time. The term of the CD range from 3 months to 5 years. The longer the term, the higher your annual percentage yield. The downside of traditional CD, however, is that you won't be able to withdraw money before the term is up. You will usually have to pay a penalty for early withdrawal. The good news is that the interest rates on CD tend to be higher than those on traditional saving accounts. It reveals that you will be able to have better return at a trade-off while having no access to your money easily. Another safe and important technique is invest your money in a money market fund. Money market fund is a great option for those who don't want to take on the risk of investing in stocks or bonds, but want to earn interest on their money. According to Chavis Ford, a certified financial planner, CFP, and senior wealth manager with Lord Murray, MMFs invest in debt securities, including U.S. Treasury bills and commercial paper. They are among the safest investments available and pay monthly dividends. Yields are usually close to or slightly higher than a bank saving accounts, and they are highly liquid. You can withdraw your money at any time. You can buy MMFs from banks, fund providers like Fidelity Investments and Vanguard, or open a brokerage account. Number 6 is buy treasury bills. Treasury bills are backed by US government and offer a fixed rate of return over a specified period. You will get a good guaranteed rate depending on how long it takes to pay it off. As long as you hold it until maturity, you don't have to pay state income tax, says Chavez. Because there is term, this option offers less liquidity than a money market fund. The term can range from a couple of days to a full year. Buying treasury bills can be done directly through the website Treasury Direct or through a broker such as Fidelity. The sound strategy is invest in stocks. If you are willing to part with a $1,000 investment for a chance at higher returns at a higher risk, Chavez recommends investing in stock index funds. These investment funds track a benchmark index like Nasdaq 100, S&P 500 or other index. The money you invest in a fund invests in all the companies in the index, allowing you to diversify your portfolio more than if you were to buy individual stocks. Many financial experts say if you have long-term investment plan, then index fund is a great option for you. In this way, you will be able to get diversification from the market, paying no trading fees and with minimal costs. An index fund can be invested in a brokerage account, traditional IRA or Roth IRA. Most of the top stock traditional platforms do not charge commission fees, such as TD Ameritrade, Vanguard, Fidelity, and investing apps such as Robinhood, Webull. Both apps also offer fractional shares access. Fractional shares allow you to buy a percentage of stock that is less than one whole share. This allows you to diversify your portfolio using less money. The last technique we will recommend you guys is use a robo-advisor. If you want to invest but don't want to take a hands-on approach, you can opt for a robo-advisor. A robo-advisor will automatically invest in a variety of index funds and exchange-traded funds, ETFs, based on your objectives and risk tolerance. Most robo-advisors have low or zero minimum opening deposits and much lower management advisory fees compared to traditional financial advisor. We recommend Investment and Wealthfront for the best robo-advisors out there. At the end, we advise you people, there is no need to wait for thousands of dollars to get started with investing. Even a small $1,000 contribution can make a big difference if you make it work for your financial future. Whether you are just starting out, paying off debt, adding to an emergency fund, or ready to invest in stocks, a small initial investment can make all the difference. These are the 8 best techniques you can use to invest your $1,000 and you can turn it into millions in 2023. And guys, if you think it valuable and informational, please don't forget to subscribe our channel.